Welcome back, everyone, to the Audacious Money Witch channel, where we talk about the magic behind the stock market. All right, team, I did it. A little while back, I made a video talking about the Honest Company. And I said I'd be a buyer if the stock hit a certain price. Well, I pulled the trigger. I bought more. Now, looking at the charts, you might be thinking, girl, what are you doing? The stock is down over 40% this year. The headlines talk about struggles, and there are some serious red flags hiding just below the surface that most people are missing. So the big question is, am I seeing a massive opportunity that everyone else is overlooking, or did I just make my riskiest investment of 2025? Stick around because we're going to peel back the layers on this thing, find the hidden truth, and you can decide for yourself if I'm crazy or clever. The Rockstar CEO and the bull case. Okay, so before we get into the spooky stuff, let's talk about why I was even looking at the Honest Company in the first place. And honestly, the bull case really boils down to one person, the CEO, Carla Vernon.
The word changemaker is such an inspiring word. It is an honor to be recognized as a changemaker because driving change and driving towards the future has been something that's been important to me since I was a little girl. Confidence is that energy you give yourself to just believe something is possible, even if there is no proof whatsoever yet that it is possible.
She took over in early 2023, and her resume is basically perfect for this job. She spent over 20 years at General Mills, where she actually ran their natural and organic division. Think of brands like Annie's. So she knows exactly how to scale a good-for-you brand. After that, she went to Amazon and was a VP overseeing things like baby, beauty, and personal care. So she understands both the old school retail world and the new school e-commerce beast. When she arrived at Honest, she said it felt like cars were moving in too many directions. The company was a bit of a mess after a rough 2022, so she immediately launched what she calls a transformation initiative. And folks, the results are speaking for themselves. In 2023, revenue grew 10% year over year. This year, the growth is accelerating. They grew 10% in Q2 and a massive 15% in Q3. This was so strong, they actually had to raise their forecast for the entire year. This isn't just a small turnaround. This is a company hitting its stride. They're a small fish in an $80 billion pond, and they are growing way faster than the industry and actively taking market share. So how is she doing it? First, she built a killer team, bringing in experts from places like Clorox, Mattel, and Estee Lauder. She got everyone on the same page with a simple acronym she created, FIFA. It stands for Focused, Executionally Excellent, Fast, and Aligned. It's a simple gut check to stop the team from getting stuck and to solve problems quickly. It shows she's a real hands-on leader. Second, and this is the most important part for us as investors, is her strategy for distribution. This is where the massive opportunity lies. She calls it stores, doors, aisles, and shelves. The goal isn't just to get into a new store like Walmart. It's about getting into more Walmart locations, doors, getting into more categories within those stores, aisles, and getting more of their different products stocked on the shelves. And here's the mind-blowing stat that every bear seems to miss. While the Honest brand can be found in about 85% of stores, their best-selling individual products have barely scratched the surface. Get this, their leading moisturizer is in less than 40% of stores across the country. That's not a weakness, that's an enormous runway for growth. Like she says, the correlation between points of availability and revenue are the most directly correlated driver of how your brand scales. She's also being smart about innovation. They created a flushable version of their wipes. It sounds small, eh? But that one change got them into a whole new aisle in the store, putting the brand in the front of totally new customers. So you've got a rockstar CEO with the perfect background who has a clear plan that is already delivering incredible results. The team is stacked, the distribution runway is massive. So a great brand, a CEO who is executing flawlessly, a monster growth numbers, and a clear path to getting even bigger. Why on earth is the stock getting hammered? The bear case, the hidden dangers. All right, this is where we need to put on our detective hats. Because when you dig into the numbers, you'll realize the growth isn't coming where you think it is. The first big kinda weird red flag, apparel. Yeah, clothes. Based on their filings, over half of the company's growth in the last couple of years came from apparel. Part of this was a weird accounting change. But the point is, it's not diapers, it's not skincare, it's clothes that are propping up the headline numbers. When the analyst asked the new CFO about how big the apparel business was, he totally dodged the question. Not a great look. And look, selling baby clothes isn't a bad thing, but it's not the high margin, reoccurring revenue business that made investors excited in the first place. The crown jewel was supposed to be the diapers, but guess what? Diapers revenue is actually declining. That's a massive problem. It suggests that in their most important category, they're losing the ground. So while the company as a whole looks like it's back on track, the core business is actually struggling. The growth is coming from lower margin, less exciting categories like wipes and apparel. That's not going to get big investors or potential buyers excited. The second huge issue is distribution. Where do you actually buy Honest products? If you said Target or Amazon, you're right. A whopping 64% of their sales came from just these two companies last year. That's a terrifying amount of concentration risk. Target has been having its own struggles, and they recently changed their diaper assortment, which hurt Honest. The CEO even admitted they're in less than half of the stores they could be in. They're trying to expand to places like Whole Foods and Sprouts, which is great, but they have a long way to go to catch up. And to make it worse, they're moving away from their own direct-to-consumer website, which will likely cause a hit to revenue next year. So to recap the danger zone, the growth is coming from the wrong categories. The core diaper business is shrinking, and they are dangerously reliant on just two retail partners. Ouch. My thesis, why I bought it anyways. Okay, so we have a seriously conflicting story here. Strong turnaround on the surface, but deep structural problems underneath. So why, after all that, did I click buy? Well, it comes down to these three things for me: price, people, and patience. First, price. I bought it at $3.50 a share. I feel like a lot of this bad news is already baked into the stock price. The market isn't blind. It sees these issues, and that's why the stock is down 43%. My thinking is a classic: heads I win, tails I don't lose much. The downside from here feels limited, while the upside, if they can solve even one of those big problems, could be significant. A double from here isn't a wild fantasy. Second, people. I'm making a bet on the new leadership. Carla Vernon has a history of success at major companies. It seems like the previous leadership really struggled to manage the company's growth. She's making the tough but necessary changes. It's painful now, but it could set them up for long-term health. I believe she's harvesting the low-hanging fruit now, and the real strategic growth is yet to come. Third, patience. This isn't a get-rich quick stock for me. This is a 5 to 10 year story. I'm watching for one key catalyst, distribution wins. If over the next few quarters they announce significant new retail partners, getting into more doors at Walmart, Kroger, Sobeys, Loblaws here in Canada, wherever, that's the spark. That's what will prove they can solve their biggest problem. The new diaper launch could also help them win back some shelf space. So my investment thesis isn't that the company is perfect right now. It's that it's a beaten down, underappreciated brand with a new capable manager, and the price has gone low enough to justify the risks. I bought 1,000 shares at a price I was comfortable with. So that's the full story. It's not a simple buy this stock video. It's a messy, complicated, real-world investment. You have a solid brand fighting to fix its biggest flaws. For me, the potential reward at this price outweighs the very real risks. But I want to know what you think. This is where we learn from each other. Looking at the bull case and the bear case, what am I missing? Are you buying, selling, or staying far, far away from the honest company? Let me know down in the comment section below. I read and reply to as many as I can. If you got any value out of this deep dive today, do me a favor and hit the like button. And please subscribe so you don't miss the follow-up videos. Thank you for watching and hanging out. Stay smart, stay patient, and I'll see you in the next video.